Right, ladies and gentlemen, good morning, good afternoon, good evening, good day. As I see many of you are joining from all parts of the world, can I, on behalf of Sullivan and Worcester, welcome you to what is our first webinar of the year. We're going to be running on the webinars on a regular basis, so if you have any ideas, please feel free to either put them on the Q&A or the chat line, or send us an email, and we'll see if we can accommodate you on that. Also, if there are any questions that occur to you, there's a Q&A button, and I will try and find time at the end of this webinar to answer those questions. Anyway, the subject I chose for today is, as you can see, transferring risk in trade assets using participations, and then is the BAFT MPA way always the best? What prompted me to do this is that I wanted to look at some typical structuring and some work that we've been doing over the last 2 or 3 years, which has prompted that sort of question. So if we can go to the next slide, please. So what am I going to do? What am I going to talk about? For the last few years, there have been more and more structures using participation agreements. We've often been asked to make changes for specific transactions. And I thought it was time to have a discussion as to whether, if you like, the BAFT Master Participation Agreement is fit for purpose. I'm going to have a look at what are trade assets that we might be using in our transactions, looking at transfer of risk. And I want to just step back and see what the BAFT Master Participation Agreement was designed to do, what has happened since, and then to look at the needs of the parties, the new terminology, seller and participant, and just to look at the law behind all this and the accounting requirements, whether they matter and what that is doing. Then I'm going to have a look at different forms that have emerged and are still emerging, to consider whether there are other options available, and then to ask you the question, is it worthwhile moving the BAFT document forward, making something more focused, and then to try and summarize all of that in the time available. So next slide, please. So if you think back to what BAFT was originally designed to do, it was looking at payment obligations. It was looking at letters of credit, bonds, confirmations, and so on. Receivables, even in 2018, was seen as an add-on. And indeed, if you looked at the appendix to the guidelines that accompanied the 2018 version, there was some expanded wording to deal with receivables. And what's happened in the meantime is that there's an increasing use of participations for receivable transactions. The difference between funded and unfunded has become quite important, but equally, the need to split these out for reasons that I will get on to, so that a funded participation is likely to be loans, receivables, payment undertakings, where the seller asks the participant upfront for money to meet its own funded obligation. There's an argument that says that unfunded are more challenging, because here what the seller is looking for is to have somebody undertake the risk, because the funds are not required immediately. If you focus on letters of credit, there's clearly a difference between a documentary letter of credit, which means that it is designed to have a situation where the issuer or the confirmer of a letter of credit will pay, i.e. the seller says, I'm going to pay, will you join me at that? Or a standby letter of credit where the issuer says, I might have to pay, and I want you, the participant, to take that risk. And that takes you into other unfunded commitments like performance bonds. There is a difference, as we'll come on to, in just the capital treatment and indeed the whole treatment of a participation that is relevant for all of you. Next slide, please. So if I can just take you back a moment, the original BAFT was launched in 2008 and was really structured as a debtor-creditor between grantor and participant, like a limited recourse loan that the participant made to the grantor. That was contrasted by the US version that came out a year or two afterwards. And consequently, when we looked in 2018, I was invited to join a drafting group by BAFT to see what we could do in relation to the BAFT. And what we did was we turned the BAFT, the English law BAFT, into a sale and purchase of participations, which initially started quite slowly in take-up. But now looking back to nearly 5 years, the speed of growth has grown in relation to the structure. And we also created a number of other mechanisms within the 2018 BAFT. So it was designed primarily, if you go back to 2018, to operate between banking groups. It had the concept of a master party that signed the participation agreement, but actually any group entity could be the seller or participant under an offer and acceptance mechanism. It meant that you didn't have to change the master document at any time, but the participant or seller in the offer and acceptance joined on that basis. It remained flexible that you could deal with funded and unfunded participations. But the key element, clause 6, if you want to look into the document, was the ownership transfer when funded and the risk transfer when unfunded. And that was the driver in relation to the BAFT document. Move on to the next slide. Now, what is interesting that I would say within the current BAFT document is a very key assumption reflected, for example, in clause 20.4, is that the participant takes document risk. In other words, that the seller says to the participant, here's a transaction, here are the documents. If you want to accept my offer, you do so on these terms. And I think in 2018, the general thought was that was quite reasonable for the seller to say to the participant, here's a transaction, you do the due diligence. And the consequence of that is quite limited representations from the seller and limited obligations on the seller during the running of the transaction. We took out a reference to fraud risk specifically, but the argument is that the seller accepts certain responsibilities dealing with checking of documentation under clause 15 and just how it deals with the transaction under clause 19. But mechanically, each transaction starts with an offer, which there is no obligation on the participant to accept. So you have a master document that is actually two-way, so you could be either seller or participant. But when you got to an offer, you'd be making the offer either as the seller and accepting it as the participant. So in other words, there were specific transactional provisions, but they went in the offer and acceptance. And that meant that the participant then had certain rights post-completion. He controlled certain changes, but essentially the seller still ran the relationship with the underlying obligors in the transaction. And so the question that is becoming more and more relevant is what risk does the participant accept? I mentioned above that the documentation risk, which the participant would be accepting, he would accept the non-payment risk, but is there more? And then if you drill into the definitions in the master, there's a list of who the recourse parties are, reflecting what is offered to the participant. And then there are related recourse rights, the recoveries, under which the seller has to pay funds over, holds them on trust. So structurally, particularly with the extra part regarding receivables, the argument is that the BAFT document works. And if it does work, why change it? And the answer that I would say is it does, but sometimes the purpose for the participation is changing. So let's have a look at the next slide. So what's been happening? Well, I would argue that it's a sign of the success of participation structures that we are discussing the use of BAFT, modifications to BAFT, because I will run through this and I hope conclude that it's a good tool. But what you need to do, because it's good, is you need to tailor it to the transactions. And the question then is what to do in relation to the tailoring. Because perhaps the original idea was that you might participate a single letter of credit, whereas now, particularly with receivables, is that you have repeat transactions which may well revolve. So you don't want a new offer every time there is a receivable being participated, but you may want something else. And that means that making the offer and acceptance more detailed is quite possible, because the current schedule that's in the BAFT is very short. It lists a series of headings, but it's quite flexible. So you could make them, and should make them indeed, more specific. But perhaps better still is to write a more specific participation agreement to reflect the transaction. Why would you do that? And the point is that that's often driven by the seller, who wants the participant committed for its own internal reasons and the legal and accounting points that I'll come on to. So the seller wants to say to the participant, I don't want you just to say you might accept. I want you to be committed to accept the offer when I make it to you. The participant says, well, actually, I want to know specifically what you're going to offer to me if I'm going to be in any way committed to accept. So I want to know what the assets are going to be. And actually, I know what I want. And the documentation on the basic BAFT may not provide that. So the question then is, how much do we rewrite? And if we're going to rewrite it, should we rewrite it into a template master, or do we allow for individual documents to continue? I would say that the BAFT structure is still a sound basis, but I know many of the banks, probably a number who are on this call, have actually taken their own BAFT type structure and made amendments to them, or are running their own participation documents alongside the BAFT document, sometimes using one, sometimes using the other. So the question that then arises, are there common issues that are being changed, or is it the vagaries of seller and participant? And could they be solved by other templates, or is there another way of standardizing this? And if you step back before we get on to that point, because there is one issue that I'd quite like to look at, is what are other drivers in relation to the need to delve into your BAFT style document more closely first. Next slide, please. So what I wanted then to look at for the next few minutes is why changes might be useful if you look at the legal and accounting analysis. These are interlinked, and in many ways they've always been there, because as I said before, the BAFT English Law 2018 was changed to grant a sale to reflect what the New York Law 2010 document had done, so that BAFT 2018 English Law, BAFT 2019 New York Law are much closer in their purposes. And what they were designed to do is to achieve an off-balance sheet treatment of particularly a funded participation, i.e. a true sale. And I'll come on to that phraseology over the next few slides, as you'll see. Now, what's happening also is the accounting treatment, driven, of course, by a specific auditor and an auditor's request, means that we drive into the legal analysis of true sale in particular and risk transfer more than we might have done so. Now, I'm going to speak in the next few slides very much as a lawyer and not as an accountant. But what I'm saying is that in looking at the documentation, and indeed in looking at the advice that we give and that we have given in relation to our legal opinions, we have been trying to accommodate the accounting principles and the views of the auditors as they raise the accounting problem for an audit purpose, and throw, I'm afraid, things back to the lawyers to analyze the legal position. So let's go on to the next slide. Let me look at the legal issues. There's a key phrase that runs through the point that the accountants are making, and that is legal isolation of the asset that is being transferred. And the accountants and the accounting principles are saying, well, that's not an accounting analysis, that's a legal analysis. And that requires looking at the bankruptcy laws of the seller generally, the choice of the law of the transaction documents, the underlying documents, receivable purchase agreement, assignment, or whatever. And all of that is to be encapsulated in an acceptable true sale opinion that will confirm the legal analysis that what has happened has been a true sale, but equally is of satisfaction to the auditor auditing the seller in particular, or indeed, if you like, the participant, that the participant has actually acquired the right. And it's focused quite a lot on who controls what post the sale as it takes place under the participation agreement, and the structure that is being used. And the point is to try and view the transaction as a whole and saying, well, what is the transferor, in our participation jargon, the seller, doing in relation to the transferred financial assets? And to draw the distinction between the US lawyers' analysis of recourse and effective control over the transferred assets, as opposed to the English law analysis. And not surprisingly, I'm going to look at the English law analysis of whether we've achieved a legal true sale and whether that legal true sale works for the accounting principles that go with it. And then to leave it to you to consider whether you require a transaction-specific true sale opinion for the transaction that meets the requirements of the auditors, and who you'd obtain that from. Do you obtain it just in respect of the English law aspects, the English law participation agreement, or do you need to look at the local law of the seller in particular, or indeed of the participants? The next slide. So what are the considerations that we said for a true sale under a BAFT? It needs to be funded. And clause 6 of the BAFT master deals with that. It deals initially with unfunded and how unfunded becomes funded, then how funded participations are treated. And the key that we've always said is 6.4, which uses an equitable assignment, an English law concept, which is designed to work, which in our analysis achieves the transfer, the true sale of the participation interest in the underlying transaction. And I just give you this as a comparison, because many of you will have entered into receivable purchase agreements as sellers or indeed as buyers, where the seller collects as agent on behalf of the buyer. So the seller is still the legal owner, but the purchaser of the receivable says, I own that asset. And that's equally the case, we have argued, in relation to how we drafted the participation documentation, and clause 6 in particular. But as I've said, the accounting issues sometimes require more. A detailed analysis of what the position would be in the bankruptcy of the seller. In other words, could a liquidator of the seller or bankruptcy trustee or whatever claim back the asset or argue that the asset that was participated was not sold? Or could that seller or the liquidator, or indeed a creditor claiming through those parties, argue there is no obligation on the seller to pay money over to the participant, notwithstanding the terms of the document? And what we have said is that the manner in which, as a matter of English law, the document is constructed, including clause 6 and clause 12 regarding monies held on trust, means that the asset that is being participated is indeed isolated from the estate of the seller, even if the seller is in bankruptcy. And we've looked at elevation rights, elevation meaning that the participant can require full legal title to be transferred to it, which would mean that if elevation could be made to occur, then the participant could act directly in respect of the underlying transaction and the recourse parties, quite often without the need of the seller. And we think we can achieve that. But what that's done is that has focused the mind of participants in particular as to whether the elevation rights as currently expressed in the participation agreement should be changed and made stronger, so the participant has other situations where it can insist on further rights being granted to it under the participation agreement. Now, that's all I want to say on legal true sale of a funded participation. Feel free to come back on some of those points. Let's move on now to another aspect. Now, credit risk mitigation is another way of transferring risk. And we looked at CRM in both funded and unfunded sub-participations, because if you meet the applicable accounting criteria for derecognition, this reduces the underlying exposure from a CRR perspective. In reality, we do not think that where you have granted a funded participation, i.e. you have sold pursuant to a BAFT participation, the funded participation, that you need to look at risk mitigation because you've sold the asset. In an unfunded sub-participation, what you're looking at is the participant pays only following default of the underlying obligor. Prior to that, there is no transfer of the seller's rights, nor is there any need to do so. But under the terms of the participation agreement, and certainly the BAFT, there is that transfer, the equitable assignment on that. So there is a risk mitigation, and a legal true sale only follows once a claim is made on the participant and the participant pays. Next slide, please. So our conclusion is that an unfunded sub-participation is capable of being eligible as a credit protection under CRR, so long as it meets the CRR requirements. And I've set these out for you, examples of what you need for the credit protection to satisfy CRM under CRR. It must be direct, clearly defined and incontrovertible. Payment must be timely. And consequently, the legal analysis and the legal opinion analyzes whether an unfunded participation is capable of being a guarantee for the purposes of CRR. And we've delivered, and we've just delivered the updated legal opinions for CRR purposes on the BAFT master participation agreements, and that's available to both BAFT and ITFA members on their respective websites. So the point is that the structure of a participation agreement is key to what goes on. So one of the issues that we've been looking at recently is to make sure that the participation is granted on an unfunded basis in all payments that the seller has to make. The BAFT is structured for these purposes, and it's a key issue, and indeed is an attachment to our opinion, is changes that you make to the BAFT or to any participation document unfunded that affects the CRM protection will be important. Let's move on to the next slide, please. Now, what I've extracted with my team is just a couple of things. US GAAP requires financial assets to be legally isolated. As I've mentioned, from a true sale legal point of view, that point is made. If you look at the accounting standards, the same point is made about legal isolation. Look at the wording in bold: presumptively beyond the reach of transferor and its creditors. Transferred assets would be beyond the reach of the powers of a bankruptcy trustee or receiver. So that's what we're being asked to look at. We believe that those statements can be made as a matter of English law, and then it's an issue as to whether, if you like, the bankruptcy trustee of the seller is prepared to recognize the English law underlying document and not seek to try and recategorize, for example, a participation funded as being just a loan that's would have been secured on the assets, but no security has been created. Set-off rights, just as an aside, don't affect isolation, which is good news, but we say that a true sale works. Next slide, please. The bullet points on this slide are really there for your guidance. And I just take you down really to the fourth bullet point, is that there is a difference on accounting true sale analysis between IFRS and GAAP. We try to cover both whenever we are asked to look at delivering a true sale opinion, generally for the benefit of the seller, but sometimes for the benefit of the participant as well. But just noting the difference that ISAB being more generally used, but GAAP being used in the US. The US ones are rule-based. The IASB are principle-based. And so there is a difference between the two, as you can see on the next slide. Now, this table is very much related to how you structure and in some ways based on some of the writings of accountants who were looking at, in some ways, more sophisticated transfer structures using, for example, securitizations, using SPV structures, rather than, if you like, the more straightforward way of dealing with under a participation document with seller and participant. But we've done back-to-back participation documents. So all of these issues are important, but the idea is to try and look at what's going on in totality. But I know, for example, that in some cases there's been an argument that if the seller, for example, retains a skim in a funded participation, that is not a transfer for the purposes of true sale. And I'm not going to get into that on this presentation, but you do need to look and have a think about that going forward. So having given you, I hope, a headache in relation to accounting issues, let me go back to where I really want to get to, which is the drivers of changes of approach and drafting. Next slide, please. So what's going on? Well, we've been adapting the BAFT framework for specific transactions. We have, in a number of cases, just amended the offer and acceptance, but sometimes that's just considered too cumbersome, although it's possible, and consequently, the drafting changes driven by parties who say, here are the terms seller to participant, and here's my transaction term sheet for this participation. Can you, the lawyers, take the BAFT document and change it for this specific transaction? Can you, when you make those changes, also show how you've changed the BAFT document? Because that may help the participant, or whoever's drafted this, understand the relationship, how it's been changed. But essentially what we are structuring is a participation that uses the principles of the BAFT documentation, but reflects those previous slides that I've given you, the legal and accounting issues, which continue to drive the requirements. But more importantly, the business requirements of the transaction are then more closely reflected in the specific transaction document that we prepare. And so consequently, we are invariably asked to answer the question, not can we use the participation document to transfer risk to sell, but does the document transfer risk? Have we, the seller, sold the participation in the underlying transaction? Have we, the participant, bought it? So where are we if we've got to do all of this? Let's move on. So what's becoming clear is that the BAFT document was very good generically for quite a number of potential documents that are listed, potential assets that are listed, but including receivables and other unfunded liabilities, if you like. And consequently, what's happening is that participants are saying, well, actually, perhaps I will participate in this transaction, but here are my criteria, eligibility criteria, under which you can make the offer to me and I will be bound to accept. And within all of that is what one might describe as the concentration risk. I don't want to be exposed to an obligor for more than a certain amount. I don't want to be exposed in a country or so on. And so consequently, we are seeing structures that detail and extract from the generic asset specificity for eligibility and concentration risk. Question, is this transaction funded or unfunded or both? Sometimes we're being asked to create a straightforward funded participation because that is what's being sold. and we can take out references to unfunded, or vice versa. And indeed, when we created the ITFA unfunded participation agreement, that was very much focused on a participant taking risk in unfunded. The timing and level of commitment becomes important, and indeed conversion of unfunded into funded, because if the mechanism is that the participant, for example, says, well, actually, I don't want to fund on a daily basis, I only want to fund on a weekly or monthly basis, but as seller, you want the unfunded part to be covered the moment you go on risk, we can split that out. So structurally, there are all sorts of ways of dealing with this. And a key further element is that when we are drafting a specific document, we quite often make it one way. So instead of having master parties, could be buyer, could be participant, could be seller, we describe who the seller is, and we describe who the participant is, which may or may not be a single party or more than one party. And then, of course, what we need to extract from all of this is the rights and obligations. Did the BAFT master, which assumed very much equal standing between seller and participant, need to be changed because the types of parties are different, the transaction is different. That then takes you on to what would we often want to look to change. Next slide, please. So as I said before, the seller wants a clearer obligation on the participant to take a risk in the asset being participated. The participant equally wants a very specific statement of its risks and rights when it participates. And those 2 points go together. The net effect of that may well be the need to amend the seller participant representations from those which are contained in the master to being very specific as to what should be in this particular transaction. And that consequently means that the amendments of the parties' rights and responsibilities may well need to be changed to reflect the onus on whoever has agreed to sell, who's agreed to participate on what terms. Closer consideration of elevation rights and timings I've mentioned, and that might be perhaps because the participant is more aware of the risk that it might be taking and consequently of its requirements when it participates in the transaction. Now, often there's a different understanding, or one might say a misunderstanding, particularly between parties to a participation transaction, where some of those parties, the participant generally, is a non-bank. And consequently, describing what is being participated may be requiring a greater focus on what the participant needs. The participant says, well, hang on a second, let's look at what I'm doing. I take credit risk only. So I accept that I have to pay if the underlying obligor doesn't pay in an unfunded transaction. I accept in a funded transaction that if the underlying obligor doesn't pay, then I don't get paid back. But if it's for any other reason, if it's a documentary problem, I don't want to take that risk. And that means that the approach that we might need to take is to clarify these points within perhaps the document in a way that we perhaps haven't done at the moment. So next slide, please. So if I'm right that we need to make changes, is it possible to standardize this changed approach? Well, the simple answer, I suspect you would have me say that, you would say that, wouldn't it? Is no. But what I want to try and do is to say that there are clearly areas that are worth looking at to achieve a better starting point, especially where the participant is a non-bank, or in situations where you want to clarify the rights and obligations of the parties from the different position adopted in BAFT, which is, here's the document, participant review it. Now, the terminology can certainly help that. And there are other efforts going on, which I won't cover today, but are being covered separately, to make negotiation between parties easier by clarifying what is going on. I'll come on to a couple of those points in a moment. Clarifying the rights and obligations of the parties, and that does mean focusing on representations and what the seller has to do, does become more important in a different structure from what we're talking about. If there are clearer rights then and obligations of the participant, then those rights and obligations of the participant might be easier to define. And one point that invariably comes back from the participant is saying, hang on a second, if I'm taking an unfunded participation, I want to be paid for that. I do not want my fee for granting that unfunded protection to be dependent on whether the underlying obligor pays. In other words, a bit like an insurance policy, you pay a premium up front to get that cover. In a participation agreement, participant may well want to make that clear. Just a point for you to note. Next slide, please. I'm picking on one definition, trade receivable, because it's clear to me that in the work that I do in receivable purchase, how you evidence the trade receivable is in very many different ways. And that may be quite crucial in a participation as to who is taking what risk. And here I would turn to the payer of the receivable, the buyer of goods. In other words, payable financings, where the question is often raised as to, well, what is the buyer agreeing to pay for? Will he give something like an IPU, an irrevocable payment undertaking? If not, can that receivable, that payment obligation, be reduced by set off credit notes and so on? Who takes that risk? Because that's something that we need to clarify, where the participation agreement doesn't deal with that specifically, because it says go and have a look at the receivable purchase agreement. And here we're saying perhaps you ought to make that more specific. What about what the seller is saying? Is he making statements? Is he prepared to make statements about the underlying transaction, the documentation, and its purpose? There are some representations in BAFT 2018, but they may well need to be expanded, particularly where there's a non-bank, because what we need to deal with more clearly is to clarify when and for what reason the participant pays if he's unfunded, or doesn't receive payment if it is funded on that. And we have to balance all of this with the legal and accounting considerations. Next slide, please. Now, if we abandoned the BAFT MPA as a base document, what could we use? What would we use? Well, it seems to me that we need a very specific form of document which is reflective of the asset or the responsibilities. For example, if instead of selling a funded participation in receivables, you might want to use a receivable purchase. And as I say, that you could therefore make the participant act as the purchaser, but have the seller collect, but you still have a long document that deals with that. If you wanted to sell a participation alone, well, you'd have to transfer it. You might use the transfer mechanism already built into the document. Otherwise, you might need a novation agreement. If you wanted to find an unfunded participant or a participant in an unfunded obligation, you could have a guarantee, you could have an SPLC, you could have insurance. So in all those situations, you still need a document that reflects the obligation of the participant as against the seller, grantor, or whatever. And I would argue that each would work, but actually it lacks the flexibility of the BAFT master. So consequently, the BAFT master works, but it may indeed be useful to make it work even better, to have some variations or modifications, particularly in relation to the inventiveness, or as I suspect, of some of my audience today, who may well want to use participations for other reasons and other purposes. So let's try and draw this to a conclusion. Next slide, please. So if you accept my thesis that the BAFT master participation still works, it's a sound way of structuring. It was sound in 2018 and it remains sound in 2023. It can satisfy the legal and accounting requirements, but remember, as your respective auditors dig into your documentation, they're going to look more and more closely at what is in your particular offer and acceptance or your particular participation agreement. And consequently, it is well worth always saying, look, this is based on BAFT, because as I've said, the BAFT works particularly well between banks, works particularly well in a situation where the bank's relationship seller participant may well be different. Today I'm seller, tomorrow I'm participant, and so on. But these, of course, may well need changing, where one party is always the seller or is always the participant. And indeed, that is a lot of the changes that we've been making to the document, which is to make it one way. And consequently, once it is one way, you then reflect the fact that party A is seller and party B is participant. And the document will then flow to reflect those respective positions, because there's no need then to have the mutuality. Seller says, this is what I'm saying in this transaction where I am seller, and this is the participant says, and this is what I want in this transaction where I am participating. Can we provide other options? Well, that's a question, I think, for the market to consider, for BAFT, for ITVA, and indeed for many of you on the call, as to whether we could create some template or whether we should just continue to tailor the drafting for a specific transaction. And I really leave that up to you. But I leave you with two thoughts, if you like. Participation is a good structure, is a good way of achieving the transfer of risk, the sale of an underlying funded transaction, and that the BAFT way should be the way ahead in whatever route we choose. And I would say that, wouldn't I? But I think that a lot of time and effort went into that document, that structuring, and we have looked quite a lot at this going forward. And whether we adjust it, as many of you know, we adjusted the BAFT masters to reflect the demise of LIBOR. We've reflected things like the bail-in changes, that's always there, so that we may well perhaps produce appendices, or we just carry on structuring. But I hope that that opens your eyes, or whatever, to some of the thinking that that goes on in relation to the structuring of BAFT documentation. Now, I have a couple of questions that have been raised. Let me try and answer them. You still have time if you want to add any questions to this. CRL rules, there is a requirement for timeliness of payment. in a participation agreement. Absolutely right. I did mention that. It's not on the slide because we were just listing examples. The timeliness issue is, of course, quite interesting. The BAFT master has quite short timeframes, 4 business days for making the payment. That does not mean that if the participant asks for longer, 30 days or whatever, that would not be timely for the purposes of CRR. These are the points that you can discuss and negotiate. Interesting question about cases testing, whether effectively an equivalent assignment works. Well, the answer is yes. I think we can demonstrate cases because we can demonstrate that for the purposes of English law, an equitable assignment transfers the rights as between the transferor, i.e. the seller, and the transferee, in this case, the participant. So we are happy that as a matter of English law that works, and consequently, we would expect, and our opinions, if you like, reflect the fact that we would expect an insolvency practitioner in the UK to accept and to recognize that transfer. The issue that invariably comes up is, do I think that an insolvency practitioner in the seller's jurisdiction would follow that? And that's where there's a lot of the debate. He should do, because after all, in a funded transaction, remember, the seller has been paid. So for the seller to turn around, or the seller's liquidator to turn around and say, yes, I've been paid, but by the way, I want to dispossess you, the participant, of your rights to the recoveries, would mean effectively a double recovery in the hands of the seller. That's our issue. It needs to be discussed further. The structure that someone's asked about, multiple investors, yes, that's always a challenge. Does BAFT deal with the scenario? Well, the answer is that BAFT could deal with it, and certainly we have written, if you like, almost like a syndicated participation in BAFT, but it comes back to whether you want to tailor your BAFT document more closely to the transaction. The point, for example, if you've got more than one participant, who makes the decision where the seller says, okay, I agree that I can't make the decision, I therefore need you, participant, to tell me. And of course, in that situation, the participant is who? It's a number of possible parties. And the consequence then is, do we need to reflect majority, supermajority, or whatever? So yeah, we can do it. Yes, where you've got multiple participations, you need to consider that. Where you've participated bilaterally a number of times, you need to work out as seller, what have you granted to your participant? He's taken 10%. Do you say, well, actually, you've got no say at all? So these are drafting points to consider. I would not in any way suggest that the BAFT is defective. And someone's asked a similar question. Is there merit in a multi-party participation? Good question. I think it's for markets to decide as to whether you want to do it. Platforms are looking at that. Is participation a good way to deal with multi-parties? Yes, it is. In fact, it's an exceptionally good way of dealing with it rather than trying to carve up the receivables. But this is good drafting stuff that we can discuss. The participation, the skin in the game, this is a very unfair question that someone's come up with because it puts me, if you like, at loggerheads with accountants who argue this. skim is not skin in the game, but if I grant a participation in a transaction where the interest rate or the discount is 10, that's very optimistic, but actually I want to keep 2 and therefore only grant 8, does that mean I haven't sold the asset? And that's what the argument is all about. And I'll just leave you all to mull that one over on that. Where can you find the updated Article 194 opinion? It's certainly on the ITFA website. Thank you. It's a timely reminder to ask BAFT if they have put up the updated Article 194 opinions. They did have it 2 or 3 days ago. Can I suggest, if the person who asked that question is a BAFT member, that you email Scott Stevenson at BAFT and remind him that those opinions should be available on the website. I think I have now dealt with all the questions. I'll give you a moment to reflect on that. We have a minute or 2 to spare on that. Good, so nobody has yet delivered a curveball. I'm glad to say, for those who can't see, I have dealt with all the questions. I hope that this was helpful to you. I look forward to discussing the BAFT participation agreements and so on in other forum. I look forward to discussing other issues. We will be back with a webinar, certainly in March. So watch this space. For those who didn't get a chance to listen, there is this will be on the webinar. This will be on our website in the next couple of days, as will these slides. So thank you all for listening. Happy structuring, happy participating, whether you sell or whether you participate. Thank you very much indeed. Bye for now.